Good afternoon, everyone. This is Jason Brown with PGP Advisory Services, here again with BJ Jacobs, principal at Goshen Capital. Today we have an exciting session to help give buyers a perspective on what does buying a business mean and the implications of valuation on their personal investment profile and what they're trying to accomplish through the business. BJ, glad to have you back again this week. I'll let you jump right into it.
Jason, thanks so much for having me. This is an exciting topic, something that I think about quite often and struggle with at times. It's truly an art form versus a science. Jason, I know you and I have talked a little bit about the issue of just all the components of buying a business, and something that I had experience with this week was just thinking about how do you explain a valuation? How do you explain price to pay? What is my business worth? I know a lot of buyers have these thoughts about that. A lot of sellers have very strong opinions about that. And there's a couple ways to think about it. I think there's no right answer, but I think it's really a right or wrong answer for whatever payer, right? Whatever the buyer's looking to pay and whatever the seller's looking to accept. If that works and works for both parties for their own rationales, I think, all the better. Everyone's better for it.
And we'd love to hear you go back, BJ, to the beginning, right? And so a buyer's buying a business for some reason. There's some objective, whether it be they're trying to get an income stream, whether it's they want an asset that they can grow, exit, and have a huge payday at some point in the future. And hopefully they're thinking through what are the financial implications of buying the business for them. What are they actually trying to accomplish? So we'd love to get your perspective on that activity and what it means for you personally.
Sure. Yeah. I mean, I think it's different for every entrepreneur. And I use that term pretty broadly because, it's a risky business to be in. It takes a certain kind of personality to want to go out and really think you can run a business and want to run a business and want to have that level of responsibility. So it's certainly not for the faint of heart.
Right.
But to your point, yeah, I think it really challenges the entrepreneur, ultimately the buyer, to think really long and hard about what objectives they have. First, personally, for me, I think my own style was a little more risk averse, which is why I chose the style of investing I did. And I won't go into that, but I think every buyer chooses a path, whether it's to go out and acquire a business on their own, to obtain an Sba loan, to go get some other investors.
Right.
There's a pathway to entrepreneurship or pathway to business acquisition that fits for anyone's personal profile, right, and their own risk profile. And then just based upon that risk profile, you really got to think about what's the point? What am I trying to accomplish with this business? Am I, trying to acquire, if I'm not a business owner currently, am I trying to buy my way into entrepreneurship as a pathway to freedom and income generation? Am I thinking about getting into an industry that I have some outsized expertise in and can really drive the business forward and more so the industry forward? And I see some defined growth patterns. And in that case, maybe my objective is to create a new market, expand markets, and perhaps expand my own wealth realization through an exit of some sort. Or is it, if I already own a business, is it to enter a new market? Is it just to have additional IP that I need to then go out and dominate my own market? So I think just thinking through those three individual profiles, and I know there's some others, but those are the things that pop out to me. That's probably the first question, I myself as a buyer ask myself, and that helps just clarify my thinking about any potential transaction I'd like to accomplish.
And so kudos to you, because I've had conversations with buyers who haven't necessarily gone through that level of introspection and don't have clarity in their mind around what's the play, what are they getting into, and how are they trying to execute on it. Share your thoughts then on how valuation plays. So once you've established, here's what I'm trying to accomplish, here are my goals as an entrepreneur, how that then is impacted by the valuation and how you look at valuation of a given business through that lens.
Sure. Well, it's complicated, but I'll try to make it as simple as possible. And really, the way that I think about it is, if I'm thinking about how long I'm going to think about how long I'm going to be in the business, first of all, because I think that's going to have a direct impact on how long it's going to take to achieve that goal that I set out for.
Right.
If it's going to be an income or value play, income generation play, well, then maybe I don't have a defined period to be in the business. Maybe I am looking for a very valuable revenue stream, income stream that is durable, sustainable, defensible for a decade, right? Decade plus, long term. And I think that the value of that business is going to look very different depending upon who you are. And what your goals are, than maybe a business that is breaking down barriers and disrupting new markets and working in big broad industries that has a very different growth profile. So I will say that not only do you have to think about yourself, but you also have to think about the others, like the other buyers, the other potential sellers, the industry at large. So to answer your question, I mean, one way to think about it is, if I'm thinking about it in an industry or an income play, there's a certain level of valuation in what I'm going to pay now, but there's a certain level of certainty in the income stream that I'm getting in that. If I'm thinking about a growth profile, then the income may not be as certain, but the future, the upside in future revenue growth or wealth creation potential might be much higher, but it may be more volatile. And you're going to pay a premium for that upside potential. There's really, you can't pay, there's a risk premium to certain things. It's just like anything else in life.
Oh, absolutely. And so let's talk about your situation, right? So you're a search funder, and if you could spend 2 minutes kind of going through what that is, and then what that means in terms of the businesses that you're looking at, and then walk us through what does valuation, there's lots of different ways. You got discounted cash flow, you've got multiple base, you've got multiples on revenue, you got multiples on earnings and different levels of earnings and all of that great stuff. But for you personally, I think it would be helpful for our audience to understand your situation and as a search funder, what that is, and how then do you value the businesses that you're looking at?
Certainly. Yep. I'll start the story with just maybe my career path. I think a little bit more of a traditional career path. I did not start a business at a high school or college. I did do undergrad degree and had an entrepreneurial start to my career, I think, as a financial advisor, and enjoyed having my own clients and building a book of business. Had a few other stops in my career and prepared to go to business school, and came out of business school thinking that I did want to do something entrepreneurial again, but didn't necessarily have a great path. I had this tool set of skills to deploy what I thought I could deploy into a larger enterprise, and felt like I didn't have a great idea, so didn't want to do a startup, but knew that I could make an impact on a smaller business or smaller teams, and really enjoyed the experience of having done so at some of the stops in my career in legal services and natural resources. And so one idea I had was, man, if I can get into a business that's already operating, which I think a lot of business buyers do in some shape, form, or fashion. For me, it was just, if I can get into a going concern, I feel like a lot less stress would be on me than having to come up with a great idea. I think that first $1 million in revenue is the toughest for any entrepreneur. So if I can get into something after that, then great.
Yeah.
Now, family concerns and having gone to school, and I mean, there's a certain level of like just personal life that comes along with that. Like, I'm not the youngest, so I have a lifestyle that has come along with my age, so I needed to support that. And for me, it felt like the best path was the search fund path, which is really a way for talented, entrepreneurial young managers really to acquire their way into the CEO seat of a lower middle market business. Short way to put it is typically they're typically MBAs, but in my case, have some operating experience, younger professionals that have some sort of expertise, but also have a good skill set and good operational mindset to be able to go and find a small business that has had a history of success, operates in a great industry, but has an owner that wants to transition, whether it's retirement, wants to do something else, and they may not know how to transition that business. And that's where the search fund, I think, community really adds a lot of value in deploying good talent, good young energy into great businesses that are at an inflection point. So for me, that style was, hey, I don't have a lot of money. I probably need to find some investors. I don't have a big Rolodex of wealthy people and that I know and can call on to help me buy a business. So I decided to reach out to a community of investors who can help me do that. And that's really the nuts and bolts of a search fund.
And I'd like to highlight, so I'll let you get back to finish answering the question, but this concept of risk and the management of risk and kind of different ways to get to this point of business ownership, I think is really, really important, right? So you've got not only different styles and reasons for an acquisition, but you have this option of potentially starting your own entity or acquiring in terms of being able to get to that business ownership seat. And it's one that I've looked at as well. I've worked and trying to commercialize new technologies, and the risk associated with that is extremely high. So not only does it take a long time to get to that first million, the likelihood of failure on the way to that first million and a number of repetitions and cycles to get there is also, it's important to note that road is fraught with learning and opportunities to learn. Acquisition gets you to, hey, it's an established business model, it's generating cash, and you're taking it to the next level versus just much less risky prospect in general. So anyway, I wanted to make sure that we called out that specifically, that entrepreneurship through acquisition is one pathway that de-risks the entrepreneurial route in and of itself. Like, please.
That's right. I mean, that's what attracted me to the path. I'm typically talking to companies that have already found product market fit, right. Have a good reputation behind them, have sizable profits, right? And not sure how they've deployed that cash, that free right. cash, but what's really important is that they have had some successes, right. And my job is to come in and try to professionalize the business in a way that perhaps that the entrepreneurial mindset that got the business to that point may not be the right skill set to take it to the next level, as you so eloquently put it. Right. So I think the search fund model does lend itself to a tradition, to a different style of say company consideration and what sorts of businesses fit the model and sort of level of risk that I would take on. And I think that's really evidenced in sort of the different flavors of the search fund model. And I won't get into that, but for me, as someone who has decided to de-risk my potential opportunity to acquire business, really that comes with a cost too. And that, I have some capital to pay back to investors. I have some capital to pay back to investors before I even buy a business. Right. And all of that is part of the financing model, the valuation model that I have to consider, which is why it's probably a narrower set of companies that I would consider acquiring than many others. Well, I think maybe a good point to talk about is just like some of the just nuts and bolts about, like, we talked a little bit about how to think about or what sort of things buyers want to think about in terms of like income generation versus growth. I think a lot of buyers are, right now thinking about, well, what kind of business do I think I can sort of operate? Is it a software business? Is it a tech-enabled business? Is it a all economy business? And I don't know if there's, wrong or right answers to that, and even for my own, for the search fund model. But I think that the something that I think about constantly is How can I take a business that has already found product market fit and has a good set of customers? How do I grow that business?
Mm.
Because my style of entrepreneurship does require some level of growth. In order for me to earn equity, I have to go out and put in the sweat. It's not my capital. And the only way for me to earn that equity is to provide a return to my investors through growth. So it is not the venture capital model of growth, but it is certainly trying to find industries that are big, fragmented, broad, have strong tailwinds, have grown to date, have faced some headwinds, but nothing that we can't mitigate against. But typically these are, I think of macro themes, things that aren't going to go away for the next, 50 years. And in fact, maybe accelerating and intensifying the industry. My belief, and I think many of my investors believe this as well, is that, if you find a really good industry, there's a lot of interesting things you can do. It gives you a lot of flexibility, a lot of optionality, and you can just make mistakes, like flat out as an entrepreneur. Most entrepreneurs make mistakes. I think everyone does. But you can make mistakes and still survive and not put ultimately your employees and your company at risk. So that's something I think quite a lot about is what's the industry doing? Who are the end customers? Is an industry contracting? What are the growth drivers? What are the challenges? All those sorts of things. And if I could pretty much get a good picture of an industry, it'll give me a clear line of thinking when I'm actually in front of a company and asking them who their customers are and why do those customers buy, who the buyer is inside of an organization. Is it the CFO? Is it another person inside the business? Is it a direct sales model? Is it an indirect sales model? All those sorts of things I'm considering, because ultimately, as evidenced in the last 6 months, in 2020, I think as a whole this year, a lot of things can change, and you can't always plan for those things. But if you can find good, strong industries that have really structural durability, that have buyers that aren't necessarily going to turn their back on you, that are sticky, that make decisions not based upon trends and fads. I think any business that has customers like that can really go a long way, whether it's income or growth-oriented businesses.
That's interesting. Talk a little bit then on how so as you were talking, I was thinking through to me, acquisitions, and this is just from my corporate background, right? Always start with strategy. And so in the absence of a strategy, your acquisition is at a severe disadvantage. And you talk about industry, and we could go through Porter's 5 forces and have a lot of fun going down that route. But just broadly, how do you think about competition? And as you're looking at these industries and the attractive industries, right, likely the folks providing solutions aren't the only people in the marketplace providing a solution. And how do you think about the level of differentiation and kind of the protection of whatever the capabilities are that they're bringing, delivering to their customers, and even those relationships? Talk a little bit about that aspect, because I think it's an interesting point that you bring up. There's one thing about the business in and of itself and how things run, but they're external factors, right? The business is operating in an environment. And share your thoughts then on how you view those different external factors and their impacts on the business.
Those are some really good points. And I mean, it sounds like you're thinking like an investor, right? And that's really, that lends itself well, I think, to many owners. I think it's good to be an investor that thinks like an owner. It's even better when you're an owner who thinks like an investor, the other way around.
Yep.
Because you can make decisions about capital deployment and what sub industries you want to enter or play in, all those sorts of things. You just get a different lens about value creation in your business, as opposed to being someone within a business and not thinking about how someone else would look at your business that doesn't have that risk but may want to assume that risk.
Right.
And I think maybe that conversation may lend itself more to my style, because that's how I think is.
Right.
I earn my equity as sort of the investor, but I have skin in the game, but I also have to think about others. So, gosh, I think maybe where I'll begin is um, it's it's tough to think about all of the value levers and sort of without context or in a vacuum.
Yep.
They all impact each other. One way that I tend to think about these things is trying to figure out like 4 to 5 key facts that if I can think about 3 or 4 things that I think are going to impact my success one way or another, then my odds of success are a lot higher. And if I could, those key things, if I could just narrow it to those key things, I will survive. There'll be another day.
Yeah.
I can think about another option. But I think it's different for every industry what those key things are. I think that, when you think about, I'm trying to remember the word you said about customers and thinking about industry. It changes for every industry, but and I'm trying to fish for the answer to your question.
No, and it's okay, right? And I think there's a context piece that you provided that's, I think, really helpful, at least for me, hopefully for our listeners as well, that the industry and what's going on in the industry has a huge implication on what the success of the business is going to look like. And so that industry is composed of different components, right? And so the degree to which you have competition that has a substitute product that can come in and deliver the same benefit to your clients, I would presume has an impact then on the attractiveness of whatever target you're looking at, right? And so was just kind of curious to get your thoughts on, beyond just an industry growing, right? More customers to go after, the pie being bigger, so everybody's going to be able to get a larger portion. Are there other things that you consider at the macro level as you're looking at businesses? And I do want to make sure that we get back to your thoughts on valuation right before we leave, because
Right.
Don't want to leave our listeners hanging on that. But yeah, that was.
Well, you're exactly right. Yeah, my mind was going to all the like different types of moats, right? There are economic moats, the geographic moats. There's a differentiation. There's IP. I mean, there's a lot of different things. I think those things individually don't impact value to me, to go back to the original question, but those are certainly things that I consider, right? If I feel like they're just lower barriers to entry, if anyone can just come into here's an example. I looked at an HVAC business earlier last year, and I thought to myself, well, gee, that's a really big, broad market that's that seems like it's a necessary service. It's big. There are a lot of providers. It might be there's some geographic moats to it, but some people have found ways around that. I don't know that if I'm a buyer, and me being the buyer being, if I'm a homeowner, or at the time I was thinking, well, how did I decide to buy or to select, the guy who's going to come in and fix my air conditioner last summer? It's like the first person to pick up the phone. And that thought pattern very quickly clarified to me that may not be an industry that I want to go into, because there was no differentiation to me other than whoever could pick up my phone and respond to the Angie's List inquiry first.
Right.
So that's just an example, but that's one way to think about like whether or not it's a good industry with defensible moats, and something that is a non expert in an industry that I can come in and have an impact, or think that I can defend that company's share without having a lot of industry knowledge.
Oh, fair enough. And I'll do one tidbit side note on that, because I've looked at a home services play, and part of my goal is ultimately to prepare sellers to be able to position their businesses to create maximum value, right? And within kind of the positioning of having the business ready for the type of buyer that makes sense for the business. And so these are great things for sellers to be thinking about, owners to be thinking about early on, in terms of if you're in a business where there's challenges in terms of lots of folks get into the market. What is your play? What is your strategy then to create value, to create some moats or barriers to entry for other folks? And so that might be diversifying the services that you offer and being able to get more wallet share from an individual household. So these are the types of things that hopefully our sellers who are listening to this as well are grasping onto, right? Like you may be doing well today, and by today I don't mean in the middle of the pandemic, but in general. But it's important to think through strategically what elements do you need to be building out to position your business such that when somebody looks at it from the outside, that it makes sense and that they can see where they can take the business into the future.
Yep. I agree completely.
Valuation.
Right. All right. So sort of base principles, right? I think most businesses that are north of, well, I'll say that most business owners tend to go and talk to like an accountant, someone first. Like they're typically talking to their CPA first, or talking to their attorney, saying who should I speak about this? But that's certainly not the same place that most buyers go. In fact, we're looking more outward in most cases, because what the books say the business is worth today is not what it's going to be tomorrow. Right. So from a buying perspective, I think there are two main ways I tend to think about it. Is if it's a services business that may not be tech enabled, may be tech enabled, but if it's typically a services business that has strong income, strong profitability. I typically use EBITDA as a proxy for profitability and cash generation. I typically am looking at a multiple of EBITDA for a services business that I'm acquiring. And the reason for that is the returns I'm getting from that business are going to be driven by cash generation of the business, which means I'm asking a lot of questions about operational complexity, OpEx, what capital requirements are going to be needed from day one and ongoing. And really, what does the cash generation profile of this business look like when I'm in it? Basically trying to answer the question of what's the return profile that my investors can expect, but also if I acquire the business using some debt financing, what is my cushion there? Typically, my acquisition profile, the maximum amount of debt I'm going to be able to put on the business is going to be 2 times EBITDA. So I need to make sure that, one, I'm meeting my debt covenants if I am going to use some debt financing. And two, what does that look like for a future buyer of the business? What does it look like for what it's going to take and cost me to grow the business or add capabilities? How capital intensive is the business? And then in 5 years, what is the EBITDA profile of that business? Is it twice as big? Is it 3 times as big? And that's excluding the revenue profile. Although there's a revenue component to it, I do want to think about revenue growth, but I'm typically thinking about what is the cash generation profile of that business. On the other hand, and I've looked at some really interesting growth companies, typically software companies, and not all software companies are true recurring revenue software driven companies that are cloud-based, SaaS, single code-based companies. I'm typically valuing those based upon some multiple of revenue. So those are the 2 big buckets. And there's much nuance between the 2, and obviously every business and many businesses have crossover between those 2 elements. So some software businesses have a very strong services component to it. So, and some services businesses have really interesting recurring revenue profiles to maybe one of the revenue streams. And those pieces get valued differently, but typically those are the 2 buckets.
And so let's talk about a little bit about the multiple, right? And so typically our valuation is going to have some cash flow and a multiple applied, and the multiple is where the magic happens, right? There's math that one can get to, right, through the financials to land on EBITDA. The multiple is a lot more. There's more art than science necessarily, or accounting in getting to that number. So, can you share a little bit about how you think about multiples? What are those factors that go into it? And I think it's helpful to level set, right? Current owner, seller, and a buyer. You can pull data that tells whatever story you want it to tell. So just kind of curious from your perspective to hear how you think about multiples.
Yeah. So as someone who isn't, a career long investor, I think I've turned to some wiser individuals on this point. And I think most people will say that no, you should, for a private company, there's a certain level of risk that you're just not going to have with a publicly traded company.
Right.
However, I think sometimes a good place to look is just what publicly traded companies that are, especially if they're doing the same exact service or providing the same exact service or software to the same type of customer, although much larger and more frequently and to a bigger set, then you typically start at that publicly traded company, whatever that multiple is, and then you discount back, right? It's typically, because private companies have outsized risk compared to publicly traded companies, simply in the fact that me as a buyer, I don't get to diversify our portfolio, right? I'm putting all my eggs into that private company basket, and that's not a liquid asset. I can't go out and trade it tomorrow. I literally am holding on to this business and running it and operating it. So there's a level of risk that I'm taking, and because of that risk, there's just a private company discount. So I immediately go from whatever the public company multiple is down by, some percentage, whether it's 28%, more than that, depending upon the industry, there's typically a discount. Beyond that, it's also, I also think about the size of the market. Typically, big, broad markets, think about big markets that are greater than $10 billion, say utilities or energy sector, or professional services is a tough one. But typically really big markets don't get discounted that much. They typically, because there's so much opportunity, there's so many more buyers, there's so many more customers.
Yep.
Those are really attractive markets. But when you're operating in a smaller, maybe really niche industry where, just your growth is constrained simply by the number of potential customers and your competitors, there's typically some sort of discount applied to the multiple then, in addition to that. And then it really is I would say that it's always subjective to a certain extent in terms of valuation from that, from a multiple standpoint, but I think it becomes even more so based upon financial performance. What's your gross margin? How does that compare to your peers? What is about revenue growth? How does that compare to your peers? If it's behind your peers, you're typically discounting again. Gross margins behind what the expected gross margin should be, that's typically another discount. Retention, right? So if you think about customer churn, if you're in an industry that should have really sticky customers with either annual contracts or multi-year contracts, and your net retention, meaning how many dollars you keep on a yearly basis versus those you lose, if that's sub 100%, if you're actually churning a lot more customers and you just happen to be selling new customers to replace that revenue, it's a really risky business for me to be in, I think, because then I'm just charged with having to go find new customers all the time, and there's typically a discount in that, because as a new owner, I don't want to necessarily have to sell the same customers or go deal with burnt territory. We call it, I think one investor called it burnt turf, right? Where you don't give new hot leads to like the worst salesperson who's just going to go and blow the sale. Yeah. So those are the things I think about in terms of like just how you get to multiples. But typically companies that are sub 50 million, I would say services businesses that are sub 50 million in revenue are somewhere south of probably, probably somewhere between 4 and 7, 8, 9, 7, 8 times EBITDA. And I think that varies, and I think it depends upon the industry, of course.
Yeah.
Single digit EBITDA. So you can see these multiples on, take a look at a Bloomberg or a Yahoo Finance. You can see what some of these publicly traded multiples look like, and they're oftentimes not much more than that. They're not those single digit EBITDA multiples. And then on the software side, that's why I think there's the biggest challenge in terms of seller education, and really just seller expectation, right? Because typically newer entrepreneurs or folks like me are looking at software multiples in the double digits and sort of being sort of blown back and be like, whoa, what's that? I can't afford that.
Right.
And the reality is small software businesses that may have some really interesting growth, that play in some really interesting markets, if they're not attracting venture capital, which is willing to pay outsized multiples to participate, then there's a reason why venture capital is either participating in it or that the company doesn't want it because it's expensive, because the growth expectations attached to that capital are much greater in order for the venture capital firm to then get the returns that they require for their investors, because they're expected to have a much higher return than any other style of investing. So what that means then is I'm looking at software companies that are, anywhere from 10 million and below are trading somewhere, below 5 times annual recurring revenue. Unless it's a $10 million business that just happens to be competing with $50 million software companies, and for some reason slipped through the cracks, which is rare. I'll just say I'd love to find one, and I'd love to have the problem of having trouble trying to find the check sizes to write, but I just haven't seen it. And typically, I have lots of conversations with sellers that want, double-digit revenue multiples, and you dig in a little bit further, and the revenue and the growth, and even the revenue, the business lines don't necessarily substantiate it.
Yeah, it's interesting. So I would encourage buyers. BJ, you've shared some really powerful insights in terms of how to start this process of thinking about buying a business, income generation, growth plays, risk profiles, and I get really excited because we're dealing with unemployment challenges, right, in the face of this pandemic, and a piece of this is how to enable people to step in kind of whatever capacity makes sense, right? We've had a cool discussion, which we have all the time, around one sector and segment in terms of search funds, but business acquisition is attainable. They're SBA loans, and I'll just drop this piece because I was blown away. Right now, if deals close before September 26th, and the SBA finance, there's an opportunity to have the SBA to pace the first 6 months of payment on whatever note you get on business. And so looking at acquisition as another form of accomplishing whatever one's goals are, and having the empowerment to do it is really powerful. And BJ, really appreciate your thoughts and guidance around the concepts of valuation, how you think about going about valuing the business. Part of what we try to do here at PGP is prepare our sellers a year, hopefully 2 years in advance, to tackle some of these risk areas, because that word risk came up quite a bit, right? And so de-risking the business does a couple things. For a seller, it's going to put more cash in your pockets now, and it just increases the ability of in potential cash flow of your business to generate cash flow well into the future. And so we're going to continue to have this conversation around what do business owners need to be doing? How do we solve some of these things that BJ's seeing in the marketplace? And it's not a 1 month fix or a 2 month fix. It's how do we work for a year or 2 years to position the business to be successful after a transaction? BJ, any final thoughts for our audience out there today?
My only suggestion would just be talk with others. I know it's tough for For me, as a relatively newer style investor and entrepreneur, to feel like I can share my thoughts and trade notes, and I think that's only beneficial. And I think it's probably even more beneficial for business owners and sellers. I know it's tough to talk with folks that are competitors, but maybe even other sellers who have had successes and what their challenges were in those talks with potential buyers. I think it's just good when everyone's more educated before they come to the table.
Absolutely. And thank you for doing your part in helping our audience to get smarter on the subject. I learned something every time we talk. I walk away with some nuggets of wisdom that push my thinking and position me to be able to better support whether it be buyers or sellers out there in the marketplace. So really appreciate you spending the time with us this afternoon. Look forward to having the discussion also when you're on the other side and have that unique perspective of being in the driver's chair and also having gone through the shopping process. So wish you all the best of luck and continued success in your search for the right business for you.
I appreciate it, Jason. Just love sharing the information that I've learned, and look forward to chatting again soon.
Absolutely. Yeah, have a wonderful day, and we will be in touch. Thank you all for joining us today.